Thank you everybody for joining us today. See, there's a lot of new people out there, and I really appreciate it, especially on a Friday. One thing I always say at the beginning of these, this is being recorded, and I implore you guys, especially if you're newer to options trading or if you're new to this particular strategy, to watch it again, because a lot of my rules, for one, are different than the street, I guess, if you will, just being a floor trader. And some of the nuances of this may fly by you the first time through, so the second time through will really solidify this into your long-term memory. If you watch it a month or two down the road, it's just really not going to sink in like it will if you watch it within the next day or two. This is going to be the last segment of our butterflies, and this is going to be on long put butterfly if you, for the rest of this webinar. Anyway, let me get a couple of things out of the way. My name's Eric Wilkinson. Some of you may recognize me from CNBC, Fox Business, or even the Wall Street Journal for my commentary on everything from economic to geopolitical and market analysis. I've been trading my own money for well over 20 years now. I actually started out trading in college and decided that's really what I wanted to do. Moved to Chicago and started working on the Board of Trade. And I'm not here to tell you that I'm going to make you rich or that I'm going to make you a millionaire, but I am going to teach you how to take control of your finances, manage your own portfolio, and most importantly, take control of your risk. If somebody else is managing your risk for you, they're going to make the same mistakes you will. They buy the wrong stocks, they sell them at the wrong time. So if you're looking at it like you're worried about what you're going to do versus a professional, a lot of those professionals in the financial services industry, or the FAs, if you will, the financial advisors, they came from sales backgrounds, and the ones that do the best are because they're good at sales. So, and if you even just have it in a mutual fund where it's a no-load fund, there's hidden fees in there that are eating away at your yield. And if you take control of it yourself and do it yourself, you're going to end up being better off in the long run for sure. Anyway, I've traded most markets throughout my career, like I said, from the Chicago Board of Trade, and I've traded everything from stocks, financial futures, commodity futures, currencies, and options on all of these products in all market conditions. Anyway, I got to get this disclaimer out of the way, and then we'll get this on. This basically says any opinions, news, research, analysis, prices, or other information contained here or material provided by ProTrader Strategies, associate companies, and or employees is for general commentary and does not constitute investment advice or solicitation to buy or sell any of these contracts. One thing to keep in mind is, full disclosure, I may have positions in some of these different underlyings, and I'm not trying to get you guys to go out there and pump and dump this stock or anything along those lines. It's just what I see in the market, and I'm going to relay that, and it's up to you guys to really take that information and implement it in your own way. The reason why I can't give you a recommendation on any of these is because I don't know your risk parameters. I don't know what's already in your portfolios, and what I could be talking about could be counterproductive to what you're already doing. So take this information and meld it in your own way and implement it in your own, with regards to your own risk parameters and what's in your portfolio, I should say. So the bottom line is, do your own homework, and please remember that past performance of any trading system or methodology is not necessarily indicative of future results. All right, so we've gone over several different things. We've gone over the short put butterfly, the short call butterfly, the long call butterfly, and now we're on to the long put butterfly. And a lot of you guys will realize that the long put butterfly is very similar to the long call butterfly. One of the differences here with the long call butterfly and the long put butterfly is you do want to have somewhat of a bias slightly to the downside, if anything. You don't really want to do this with a bias to the upside necessarily, just because there's other risks that get involved with having short options that are in the money. So we don't really want to see that happen. So keep that in mind. We'd rather see this kind of slowly trickle downward, if anything, but we want to be market neutral at the end of the day. This says our market assumption is for the movement to be inside of the wings. Now the wings I'll go into a little bit further, but really when we implement this strategy, at the end of the day, we want it to stay pretty tight range. So although we're looking for higher implied volatility underlyings, we really want this to trend sideways. We don't want something to really be moving a ton, although when that does happen, it gives us the opportunity to make our wings wider. And I'll go into that in more detail here shortly. So the build out of a long put butterfly is basically we're going to be adding a short put spread to a long put spread. So as you can see, we're going to be buying one long in the money put and selling one at the money put. Then we're going to be selling another at the money put at the same strike, and then buying an out of the money put to define that risk. So this is a defined risk strategy, and it is IRA appropriate because of that defined risk nature of it. So you can do this if you're trading in a IRA and if you are trading with relatively little capital. So this will work in just about every single account. Yeah, Bobby, somebody will reach out to you if you want to get the previous butterfly recordings for sure. So this is that combination of those two spreads put together. So again, we're buying one in the money put, selling two at the money puts, and then buying one out of the money put. Now, what we're looking for this, a rule of thumb that I look for this particular strategy is if it's right around $50, then we're going to be, if it's a $50 stock, I should say, we're going to be looking at strikes that are $3 wide from that. So if the underlying, let's say as an example, is trading at 50, we're going to be selling two of those 50 calls and then buying a 47 call and a 53 call. And if it's a $100 stock, then we're looking at going about $5 wide. That generally gives us the credit, or sorry, the debit that we want in relation to the width of those strikes. Did I say calls? If I said puts or if I said calls, sorry, I keep saying calls. Let me start over. So the width of the strike. So let's go over this again. If it's a $50 stock and we're going to be selling two of the 50 puts, then we would be buying 147 put and buying 153 put, which would create that $3 wide strike. And if we're at a $100 stock, we'd be selling two of the $100 puts and then buying 195 put and then buying 105 put. All right, the keys to success on this is picking the right underlying. Now, I can't say this enough, and this goes with just about any option strategy that I talk about. When you're looking at the underlying, make sure that there's a tight bid ask. If there could be popular stocks out there, right off the bat, I would think of something like Hertz or something like that, where everybody knows the name and they may trade a lot of that underlying as a stock, but then the options have to reflect that. Sometimes there's not even a whole lot of participation in the underlying, but there is a lot of participation in the options. So what we want is a tight bid ask. That means, if it is a $50 stock, I'm going to be anything under $100, I'm going to be looking for less than 10 cents wide. If it goes to like $200 stock, like a Tesla, Tesla actually looks like it has a wide bid ask, but there's a lot of people in there that we used to call on the floor as being in the weeds. And that means you really don't have to go to the mid price really to get filled. You could even just better the bid or the offer and get filled in underlying like that where there's that much participation. Mark, remind me at the end, and I will go over how I got my nickname Wolfman. Does a strike have to be $3 wide? No, it doesn't have to be, especially if you're looking at a lower priced underlying, maybe a $25 underlying, then you could probably go one. But, keep in mind, we want to do this where the wings are wider to increase our probability of success. If your wings are really tight, we're trying to have it be at the mid price or at our short strikes, for a long duration of time. So the wider your wings are, the more probable you are in having this be successful. So that's why I'm talking about, on a $100 stock, it could move a $2 swing any given day. So we want to be able to stretch that out a little bit further. Brokers, it has a yellow on the left-hand side. If you click on it, it says dividend, have negative monies with this trade. Yes, you could have, if you have to worry, you do have to worry about dividends with this strategy, and I will go into that here in a little bit. All right, so what is the max width? Well, Trevor, it's really going to depend on volatility, and we'll go into that in more detail here in a little bit. It really isn't a max width necessarily, but what we're going to be looking for is in picking the right strikes and how to determine that. So for instance, with this particular underlying, if you guys watch many of my webinars, I do not like to pay a lot for my options. As a matter of fact, I like to pay as little as I can. If I'm in a position where, I am in a position right now with the amount of volatility that has been sucked out of the market, there's not a whole lot to do in regards to collecting credits for that matter. But at the end of the day, I don't like to pay a lot for any option. And this is one in particular where I am really stringent on not paying a lot because it is a lower probability strategy. Because remember, we got to nail this number where at the end of the day, we need to have the underlying trading at the money strikes for the most part to make the most money. So it makes it a lower probability trade, and in that, I don't want to pay a lot of debit to enter this strategy. So for something like a $5 wide butterfly, I'm going to be looking to pay less than $1.50 for it. And if it's $2.50 wide, then I'm going to be looking to pay less than 80 cents. So all in all, we're looking to pay, around 30% the width of those strikes is what it boils down to. I don't want to pay any more than 30% the width of those strikes. If I'm paying less, that's all the better. But you also have to keep in mind the less you pay away, lower than that 30%, say you're paying 15% the width of those strikes, your probabilities become even more narrow of success because the peak or the sweet spot becomes much narrower. And I'll show you examples of that going forward. But the takeaway from picking the right strikes, we want to pick the strikes that we're going to be paying less than a third the width of those strikes. Does that make sense for everybody? So yes, great point, David. If it is low volatility on this particular, so I don't want to confuse anybody with the butterflies are a little bit bizarre in that we're going to be paying a debit, but we do want higher implied volatility for this butterfly. Normally speaking, anytime you're paying a debit, you want low volatility. Anytime you're getting a credit, you want high volatility. the butterfly is flipped upside down, if you will. And a butterfly, when you're paying a debit, you actually want higher implied volatility, because when that volatility comes out, those wings that we bought decay quicker, and that is where we're going to be able to make more of our money. So the butterfly is opposite and is counterintuitive to the rest of the strategies of the world for the most part. So just keep that in mind. The butterfly is bizarre in that with this, when we're paying a debit, we want high volatility. When we're doing it for a credit, we want low volatility, okay? Because it's the at the money strikes are going to be affected by volatility more, okay? And since we're selling the at the monies in this butterfly, that's the one where we want to see the volatility come out of. Does that make sense? All right, so a lot of people are blowing me up. Can the strikes be determined via 2 minus 3 times a 14 period ATR? What's the ATR on that? The high volatility with debit in a butterfly will enable us to sell too close for a higher premium. When higher volatility with this particular butterfly will allow us to get further away on the ones that we're buying in order to increase our break evens is what it does. All right. They will decay. Sorry, the at the monies will decay quicker. The ones that we are short in this particular one will decay quicker than the out of the monies. The wings are going to decay also, but they're going to have one is going to have more intrinsic value. The one that's out of the money is going to be, we're going to be buying it for almost nothing for the most part. But the at the monies are going to have a lot of extrinsic value that's going to decay quicker. All right, so picking the right duration. Now, because this is a low probability trade and we want those at the money short puts to decay, we're going to pick a closer to expiration, if you will. So we're going to be trying to shoot inside of 35 days. 35 days is usually my sweet spot for this particular strategy. We're just outside of this 28 days, but you can see that this is the theta decay of the calls in red and the puts. As you can see, the puts are going to decay up rather quickly. That's just because puts have a tendency to have more volatility embedded in them. So with the puts, they're going to decay a little bit faster than the calls will, just because of that, the nature of premiums getting pumped up. As fear enters the market, people have a tendency to buy puts, and that increases those premiums rather quickly. So we're going to be trying to get inside of this 20 or 35 days, but we're right inside that, just at around 29 days. So I'm feeling comfortable with using the September options right now. So once we get inside of maybe 21 days, you're going to kind of default back out in time for that. All right, and picking the right environment. Like I said, we want the higher implied volatility for this particular strategy. Because we're short those two at the money puts, we want to see those at the money puts decay quickly. So anytime you're short options, that's where you want volatility to come out of, because those will rapidly decay. In the example here, when volatility gets pushed into these options, it actually holds off theta decay from happening, which this is the theta decay. And volatility is kind of like a balloon, if you will, underneath here, and it pumps it up. And then when all that air gets released, which is volatility coming out, the balloon deflates and this snaps back down. And that's what we're looking for in this particular strategy, is that volatility to come out. Volatility has a tendency to come out rather quickly, and that's the kind of environment we're going to be looking for. It's going to be difficult to find good examples right now, just because, I mean, everything has super low implied volatility. There's so much complacency in the market right now, being at all-time highs for the most part, that there's a lot of complacency in there, and the risk right now is for volatility to go up. So we're going to have to really put our thinking caps on and be creative in finding some good examples and know our exit strategy before entering this trade. So with this strategy, I mentioned earlier, this is a lower probability strategy. That means with lower probability strategies, I'm willing to take less than normally I say 50% of my max profit. In this, I'm going to be looking for doubling my debit paid. So in an example of where it was $2.50 wide, I said, let's say less than 80 cents. For this example, let's say we paid 80 cents for this particular strategy. As soon as it's trading at $1.80, that's where I'm going to be looking to get out of this, because we're paying 80 cents. I'm going to be looking to get out of this somewhere close to, you know, $1.50 to $1.60, doubling that debit paid. Does that make sense? And John, did I answer your question on clarifying it again? Sorry, I just saw your question. So the max loss is going to be that debit we paid. So in the example of a $2.50 wide wings on this particular butterfly, we're going to be looking at losing about 80 cents. Whatever that premium paid was, that is our max loss. And to clarify with that max loss, usually with this particular strategy, I'm going to kind of let it play out because, you know, I know my probabilities of being tested on those wings are pretty good, but I know what my risk was going into it. So I'm going to be risking what I paid off the bat to go to zero, because if it does come back down into that sweet spot, you know, in a week, then that's where we're going to be able to capture probably double what the initial debit paid was. All right, so our max profit is going to be that in the money put minus the at the money put, and then minus that premium paid. So in an example of a $50 underlying, our in the money put is going to be, say, $52.50, and we paid 80 cents for it, right? So $2.50 minus that 80 cents, our max profit is about $1.70 on the outside of that. Do you have to close this trade if you are at a max loss? No, you don't have to close this trade if you're at a max loss. I would be more inclined to close this trade if I was looking at a max loss when this underlying has rallied and basically my two short puts are deeper in the money. That would be where I would look to maybe not risk it going much further into expiration, maybe a week into expiration, because you're increasing your probabilities of being assigned on it. So but if I was directionally right in the, you know, actually, sorry about that. If the market rallied up, then that's where I would be looking to, and rallied up and all my options went out of the money, then I would let it ride. If all of my options were in the money, then that's where I'm going to look to get out of it, because I don't want to get assigned on those puts. Theta, here I'll show you. Theta will not necessarily hurt the wings more than the at the money puts, because the at the money puts are going to have the most extrinsic value in there. So The further away from at the money you get, the less extrinsic value there is on any option. And so the ones that are at the money carry the most extrinsic value, which is theta, or which will take away the theta decay. Okay? Does that make sense? And as we can see here, this is an example of Chipotle. So with Chipotle, it's a high flyer stock, and I went with starting out with the $10 wide strikes here. And Chipotle was trading right there at around 95. I think it was, yeah, 394.91. So that's about as close to 95 as you can get, right? So those are the ones that we're selling, 2 of those, and then $10 wide on the upside, bought the 405s and the 385s. That gives us $1.50 debit. Now, how do we figure out what percent is? It's relatively easy with the $10 wide, but for example, let's go, it's $1.50 divided by that $10 wide. It's going to give us 15% the width of the wings. So that's how we figure out that. Now, again, an example, as you can see, the further we go with the wings, we're bringing out our break even much further. So that's increasing our probabilities of success, but you will also know the trade-off is you're going to have to pay a little bit more for it. So in this example, we can say $3.35 divided by the width of these strikes, which is $15, and that's going to give us about what, 22 cents? Yeah, 22%. So that's getting closer, and you'll see why I like to go with the third the width. As you go to the third the width of the strike, this is right around 30% the width, paying $5.80 for a $20 wide. You can see that those break evens are further, which is increasing our probabilities of success. We're not going to be getting paid as much, or you will be getting paid more for it, but you're also increasing the debit you paid. So it's risk reward. You're risking $5, you're risking more, but you also are having more of a reward potential. And you brought out your break evens a little bit further. Okay, do you guys see how that works out? Like if we're at $10 wide on something like this, you really have to nail the number pretty tight versus the risk profile on this. We're increasing our profit, but we also have to increase our debit that we paid. And we've increased our probabilities of success by increasing our break-evens on this. Does anybody have any other questions right away? Because then we can get into the platform. This probably will explain a lot more for you guys. This is usually where I kind of go at, throw out some different underlyings that you guys like to trade, and we'll go through the steps one by one to build out a strategy around something that you guys like. Like I said, something like Chipotle, this makes it manageable to trade, if you will, for the smaller trader because of the nature of the wings that we're doing. All right, so let's start off with Amazon. First one I saw, and of course I haven't changed this in a while. It's actually going to start, the reason why I left it on there is acted as support on the way back down, so I'll just leave it for right now. It has pretty low implied volatility, which is going to have a low implied volatility percent. And the way to figure out what the percent is you take where it is currently, and you have a numerator and a denominator. In the numerator on the top of the fraction, you take where it is currently, which is 0.18, and subtract that by the low. This looks like it's probably the low, which is 0.16. You subtract those by each other and divide it by the high minus the low. So this is probably going to have almost a 0 implied volatility percent. it's 4%. So that's pretty low. That to me says the chances of this implied volatility going back up is probably better than it going further down, right? Does that make sense? So I would be leery of this particular one. Like I said, you can see over here on the side, one of the things I always look at is the IV percent, and I rank them from high to low because I like to sell or I like to do option strategies around high IV percent. As you can see, there's not a whole lot on there. And you know, even we talked about this the last time. Kellogg has a lot of participation in this underlying, and this looks like it would be a pretty good one to do. They do have earnings coming up, so we do have to worry about that. When are their earnings? On the 30th, so yeah, we'd have to worry about that for sure. But if we go into the options chain, you know, I said that anything that has, you know, under $100, I want to see it to be less than 10 cents wide, and it's pretty close, but as you can see, it's 15-cent wide. Not a whole lot of volume in there. I think today was a pretty low volume day. As we used to say on the floor, Fridays afternoon was a rush to the Hamptons, so it was difficult to trade in the afternoon as volatility got sucked out. For this particular strategy, good question, what IV should we be looking for? In a perfect world, I would like it to be above 50, because generally speaking, we're going to see volatility come out. After it spikes up, it's going to want to come out. But as you can see, now I have a handful of stocks maybe in the high IV rank, and look at this. I mean, high IV percent, and all of these are just at their absolute lows. And as a matter of fact, it's been so long to see something like this with this many stocks that have that low of IV percent. Like, they're all on their lows for the most part. I can't remember the last time I've seen one where it was just kept continuing to get lower. Did you rush to the Hamptons too? No, I actually liked it when everybody else left. Gave me more of an opportunity. So anyway, so that one, you know, like I said, it's going to be a bit of a struggle to find a particular one, but let's, for argument's sake, let's just look at this one. And it's 50 cents wide there. See what I mean? So when they're this wide, that means you have to give up, you know, to get to the mid-market. You're having to give up 25 cents to get in, and we're doing that twice. That means we're going to have to give up 25 cents to get out, and that legitimately is kind of like the profit potential we're looking for this particular underlying. You know, that's 50 cents round turn, and we're looking to make maybe 80 cents on this particular strategy. So that's really going to hurt us. That's why I want to stay away from something like that. But, you know, like I said, in a perfect world, we'd want to, and it's not to say you can't find this strategy to work out with a third the width of those strikes down here in the low implied volatility, but I would caution on that, just because to me that this is telling us that implied volatility is likely to go up whenever you have this strong of a low implied volatility market. So even Chipotle was giving me those good readings, but you can see Chipotle CMG has low implied volatility also. I was using that as an example only for the fact that we are able to get it within that third the width of the strikes. So let's look at Apple. Apple is another example we got. And Apple, you can see this is left over from earnings. I got run over in Apple in earnings. But staying diligent, you know, I'm staying mechanical, rolling those out, continuing to keep the dream alive, collect credit, lower the basis. And I do webinars on that too, how you defend that, how you manage those ones that ultimately are going to go against you, which is a reality. So you can check that out also. But let's just look at this one. So it's a $100 stock, so I'd like to at least go $5 wide, and they're only giving me $5 wide underline or strikes. So so let's check out the $5 wides right there. If you noticed, I sold the 2 at the monies, which are the 110s. That's about as close to the at the monies as you could get on this particular one. And then $5 wide. It's a $5 wide. We're doing it for $1.90. And what did I say on a $5 wide one? That's going to be a little bit too much to pay. We're going to be looking at like $1.50. So if we just went and did the math, 190 divided by a $5 wide, that's going to give us 38%. So that's pretty wide. You know, you might try and pay less and go down a ways. That's going to be pretty far away for us to get this one. The other thing is it's a 3% IV percent, so I might want to stay away from that. The other one was Bed Bath & Beyond that I noticed. You know, it's kind of right in there. 30%, 30 IV percent would be something that would be manageable. One thing we do always have to worry about are the dividends, because as somebody mentioned earlier, we do have to worry about dividend risk on this, because the dividends are going to affect those premiums as soon as they come out on the ex-dividend date, which is the 14th. But if we were to pretend that this, you know, and the one thing that I like, somebody else asked about the strike. I like to do this one around the stocks that are between $50 and $100. That seems to be the ones that, you know, you can get a little bit further away. You know, on a $15 stock, you're really going to be, you know, 1 or 2 strikes wide in order to be able to implement this strategy, and then you're really decreasing your probabilities of success on this. So with BBBY, you know, and you can also go back to the chart and look at this, you know, it's been stuck in a tight range for quite a while, and they don't pay a big dividend. That's the other thing is, you know, as you can see here, they're paying a 12-cent dividend. So yeah, it is going to decrease, you know, our option prices for the calls for that, and, you know, for the puts are going to be affected as well. A 12-cent isn't really going to affect the at the monies that much. It's more the ones that are going to be deeper in the money that get affected more. So I don't think that we'd have to worry that much about a dividend of 12 cents on a $50 stock. So we can look at this one anyway. So the closest to the at the money, it's trading $45.50. We're going to be looking at the 45 strike on this one. And it's all extrinsic value at that point. Remember, any option that is out of the money is all extrinsic value. Any of these have intrinsic value and extrinsic value. And I actually have a video on a trader hack on how to figure out quickly what the extrinsic value is versus the intrinsic value. And really what it comes down to is looking to the side here and see what the corresponding option is. So if we're looking at the puts, you look straight across, we can ballpark it at 50 cents or so, right around there. You know, we don't have to be exact on it. And when you do that and look over here and look at it at 50 cents, you can kind of check your math. You take $2 off of that. That puts that right around right 45.50. You know, if you take out the 50 cents from this, that's pretty much right around there. Now, anytime there's a discrepancy, that's the dividend that's being priced into that. So you can see that there's not really much of a dividend priced into these, so or on the calls for that matter. Because if you added the 40, yeah, so there's not, if you look at these, this is the extrinsic value of these calls. You can see that if you take the dollar out of these calls, that's the extrinsic value, because that's what's showing right there. And you take that 50 cents, add it into 45, you know, it's showing a couple pennies discrepancy. So there's really not any dividends being priced into these particular options. All right, so let's go ahead and move along. So with this one, it's pretty close to being good. So we would sell 2 of those, and then it's $50 stock. So we're going to be looking at doing $2.50 wide, and that is not a good example. Oh, because I went $5 wide. That's why. Sorry. So selling the, let's do this again. Selling the 45s. We're going to buy 42.5s and then buy the 47.5s to create that strike. So that's pretty darn close to what we want for our extreme outside. And with this one, you know, to make it right, I'd probably just drop it a couple of pennies and then work myself back up, because they do have a tendency to have pretty good participation in this particular underlying. As you can see, Bed Bath & Beyond has pretty good tight markets for a $50 stock, 3 cents wide for these right around in here. So it fits the parameter for a tight bid ask. It fits the parameter of good participation in that regard. We've got pretty decent implied volatility percent. I'd like to see it a little bit higher, but you know, and the higher this goes, like I said, we'd be able to get a little further away. We're not given that opportunity right now, but we can take a look at it. Let's say, oops, let me just cancel this one. So if we already do the 45s, we can sell it twice and then look at the 40s. So yeah, so we can do the 40s and then the 50s. You know, it's a little bit wider there. So we got $10 wide. So that's about 28% the width of the strike, right? So we can just do this, 2.85 divided by 10 gives us 28% the width. So you could even do that one. You're paying a little bit more, but you're also going to be increasing your probabilities of success, because let me see, sorry, let me get this back down to manageable. So you're stretching this out, you know. I only did $5 wide. Sorry, you guys. So that's like 48% on that particular one. So $10 wide, that got a lot worse. So selling, let me delete this out again, because that is an example. And you can even get to the point where on some of these, like where you're especially close to expiration, where you will be paying almost, if it's $2.50 wide, you might be paying $2 for this particular underlying, which does not make sense at all. So we sold 2 of those 45s, and if we went $5 wide, that would make our width of our strike, we're paying 49, almost 50% the width of those strikes. So that one would definitely not work for me. So going back to the original one, wait, let me do that again. Selling 2 of those, buy 1 of those, and buying 1 of the 47.5s. That is much better, because a third the width of the strike, 0.8 divided by $2.50 is very close to it. 0.8 divided by $2.50 going to be really close to 33%, so a third the width of the strike, like I was talking about. So that one would work, you know, and that's on the assumption that, you know, we'd like to see Bed Bath & Beyond really trade right here at the point of control, which is where the market has found value for this particular underlying. Anytime you get this right there, that it's going to want to stick there, because that's where the most buys and sells have happened. That's where the most amount of money is exchanged hands, which indicates where the market finds value. Does that make sense for everybody so far? Another thing we can look at with these, so if we go over to the delta theta, can you adjust this? In a really high implied volatility, if we found something like, that had close to, like Hertz, it's so wide, it's not a good example, but when you can get further away, in this particular underlying, we wouldn't be able to move that very well. So sometimes you will be able to take those short strikes. Don't ever move the ones that you're long, because you're going to end up decreasing your break evens and things of that nature. But if you can collect more of a credit by rolling down or rolling up these short at the monies, then that's the only way that you can really defend that. We wouldn't want to just roll it down to where our 45s were for the most part. So that's the most important thing with this one, is paying so little that you don't really have to worry about it. That's really your max loss right off the bat, because you're paying a debit. So the one bad thing about debit spreads is it's very difficult to go out there and collect more credit for it, because you already paid a debit. You usually end up paying more of a debit, and we don't want to ever pay more of a debit to try and keep something going along. Yes, Lou, this is being recorded. All right, does anybody else have any other real quick questions for that? I know I kind of went by pretty fast. Can you do a butterfly on earnings? Yeah, I mean, it would have worked out, on a earning that didn't move, but I don't like to do it around earnings, although you're going to get that big volatility crush we want to see. To me, to try and nail the number on an earnings is very difficult. I'd much rather try and figure out what the range is. And I've actually done, if you're really interested in learning about some good earnings strategies, I've actually got several webinars on good earnings trades, ones that are high probability. So you can check that out, Pro Trader Strategies. The table in the middle, how do you get it and toss? The table on the Analyze tab, this one right here. Is that what you're asking about? That's just the Analyze tab. And you can do it by, what you do is I right-clicked on the green area and went down to the menu on Analyze tab. Oh, you're asking about on the charts. This is the market profile. And I've actually done a webinar on this and how to trade this market profile. So I don't have the time really to go into all of it, but basically it's up in your, well, we call it the market profile. They call it something else, probably because somebody trademarked market profile, and that was a guy named Stottlemyre on the floor. So this is something that the floor traders always did, because we were concerned about where all the money was. Volume profile, yeah. That's what it is. It's called volume profile. You're right. And this is a very powerful analysis or chart, if you ask me, because it shows where the most time are these little, those are actually numbers in there. And we used to use like the ABCs on the floor, because those were the different time frames on the floor. And then the volume is in blue. So the point of control, where the most volume is and the most time has been spent. Trevor's asking, since volatility is so low, why do a butterfly? When we plan these things out, we do them a month in advance. So I was actually looking at a scenario when we started this long put butterfly, or this butterfly, I should say, series, and we started out in a low volatility environment a month ago. So I thought that the short call and put butterfly would be perfect for that scenario, and then that we would probably see volatility expand, but we haven't. We've just seen complacency for over a month, which, I was kind of hoping that, we're kind of looking well in advance for getting these things out for you guys, and we can't always nail the timing on increasing and decreasing volatility. So all I can do is give you guys the tools to know, when there's a really good high implied volatility environment, and we're expecting it to kind of, go from something like this, where right after their earnings, then we would start, right after their earnings would have been a really great time for this Bed Bath & Beyond, because you probably would have only been into it for a week, kind of like I had on the the short put butterfly for Nike that I did for the webinar on the 8th of this month, and we were already able to get out of that with the big move on Nike today. So we don't always know exactly when volatility is going to increase and decrease, but we got volatility, working for us, and that one worked out. The Verizon one hasn't. We've gotten directionally right with it, but volatility has come out of Verizon versus coming into Verizon on the short call butterfly. So we want volatility to come into the short call. We want volatility to come out of the long butterfly. So we can't always nail it a month out in advance, but we're trying. So, our best bet, like this would have been the perfect time to put this on, because volatility came out and it literally traded pretty close to sideways. You wouldn't have been in this strategy for very long at all. So, yeah. And will volatility continue to come out? It very well could. The markets could really get moving, and the retailers just kind of push sideways, even though we've seen some higher push to the retailers lately. Canadian retail numbers were pretty bad this morning, so the retailers could start seeing another bout of a slack in sales, I guess, if you will. So this could be a really good one. It would want to stick close to here. So, this might be one that I look to implement on Monday. So keep your eyes out for that on the daily market commentaries, you guys, because I talk about all my trades on those, and when I'm taking them off and when I'm putting them on. So, and why I'm doing it. Just like I talked about that Nike one this morning on the daily market commentary. I took it off. We got that huge spike in Nike today and was able to get out of it. Yesterday, I wasn't really at a third the width, or I wasn't at the double or 25%, because it was a credit spread, 25% of the max profit on that. But today it basically came out to, I was at 40% the max profit in one day. So it just all came together in one day and was able to take that off. So keep your eyes out for those, because I talk about that daily. How do I access your daily market commentary? If you are a member, or if you're like one of the students in the classes, you get those. That's a bonus on it. So yeah, I talk about all of the different ones. Earnings is winding down, but I basically have been going through the earnings on the ones that I find appropriate. Like I didn't take Gap. Of course, I took Deere, and that didn't work out, and the Apple didn't work out. Those were the two that really didn't work out for me on the earnings, but the rest of them were home runs for the most part. But you have those, and then I talk about how I'm, managing those losers, because that is really the most important thing to take away here, you guys, is managing. It's easy to take profits on the winners, right? It's the hard part. You spend maybe 15-20% of your existence as a trader or as an investor managing winners. Those are the easy ones. Those come quick and easy usually. It's the ones like, if you've been with me for a while, some of you guys I know have been around for quite a while. You saw me take that Twitter trade, and it went against me from like December to like last month, and I just kept rolling those. I kept rolling my short puts out and kept rolling them out, kept getting a credit, just slowly but surely, and finally we just got a little bit of a pop, and I had lowered my break even by about $2.50, actually it was closer to $3 by the end of it, and was able to get out for a scratch. So it wasn't a win, but at the end of the day, in my eyes, it was a lot of work, but I battled. I was up against the ropes and I battled out of it. So and I talk to you guys about that every single day in the daily market commentary. So that's something more people should take advantage of for sure. All right, so if you are assigned, you can offset it with the other side, absolutely. So you do have to pay an assignment fee on it, yes, but it is a defined risk strategy, and really the only time you're going to be looking to get, or in jeopardy of being assigned on this particular strategy is when you're getting close to that expiration. And that's why I, again, take a little bit less of a max profit for this particular underlying. It's because I don't ever want to get assigned. I mean, I have been assigned, and some people do it at the most inappropriate time, it seems like. Somebody assigned me on some silver, and it was against me for one day, but at the end of the day it worked out because ended up getting, they put it to me and I was long some silver in my face. The next day it rallied up a few dollars, and it worked out quite nicely for me. Probably not so much for him because it hasn't turned around since then. So you could offset that with the ones that you are long, because you can put it to the other person. So it's not gonna, it's gonna hurt you in that the assignment fees are going to take some of your profit away. But the closer you get to expiration, the more you are likely to have that happen, which is why I was talking about this. If we were doing this, we want this overall market to, because we're short those puts, we want these 47.5 puts to basically go out of the money. We want, at the worst case scenario, that would be the time where I would let it ride, because then there's no assignment risk, right? If this market continued to sell off and basically my 42.5 calls were, or my 42.5 puts were in the money, then that's when I would start to worry, because these are starting to go deeper in the money. We're looking at a max loss. We know what our debit paid was, but we don't really want to deal with that assignment risk. So that, that might be a situation where I look to close it out. Does that make sense? All right. Does anybody else have any other last minute questions? You guys, another thing, like I was talking about with the earnings trades, I tweet those earnings, the trades that I do for the earnings out. I'd say whether I'm doing a strangle or if I'm just selling calls or puts, or what I'm doing in those earnings trades. So you can follow me at Wolfman's blog, or you can follow us at Pro Trader Strat on Twitter. There's a lot of great information getting sent out from Pro Trader Strat and Wolfman's blog. I talk just about everything on there, and some snark, and I tweet out what my earnings trades are. So I don't tell you exactly what the strikes are. I'm following my rules. So if you've watched the earnings videos or webinars, then you know exactly where I am, because I'm following my rules on those. So you'll just be able to look at the strikes and know exactly where I implemented those strategies. So you guys follow us on that. The other thing is for participating in this, we've got the volatility crush. And how much did you guys, I talked about volatility throughout this whole entire webinar, and that's because it's top of mind for me. Volatility is one of the most important things, you guys, can understand when you're trading options. It is this knowledge that is going to make you more consistent. It's going to increase your probabilities of profit, because knowing when to get into an option, whether you're going to be selling it or buying it, is paramount. I mean, I can't explain it to you enough. When I was on the floor, we would talk about what volatility was going into the trading day for about a half an hour, where it was historically, where we thought it was going to go in the future. And then after the end of the day, when everybody would come back, we would talk about what we saw volatility doing, where it was going tomorrow. And it was because we had to know what that risk was over just about anything, even direction. Like, we weren't as concerned about direction as we were volatility, because volatility is what affects our premium. You know, the beauty in volatility is you can be directionally wrong, and if volatility is coming out of it, you can actually still be profitable. So I talk about all of that in this particular course. I talk about how you can scan for those different high probability option trades, how I set up my platform, and to find the high volatility things, how to calculate what volatility crush is going to do. I show you guys exactly, the quick and dirty back the envelope way to figure out what volatility is going to do in the future based on what we're looking at on those particular option series. So, it gives you a great ballpark as to where it's going to go. And so it's really important to do that. Volatility was one of those things where when it starts increasing, that's like, we used to call it, there's blood in the water, and that was the best time to go fishing, and that is how important it is. This is something you guys should know by the back of your hand. And if you want to trade like a professional trader, you really have to understand what volatility crush is going to do to you and how to take advantage of that, because you got to be quick on your feet. You're not going to have time to really go back. And right now is a good time, especially, there's low volatility right now, but the expectation of volatility going higher, and when it does, you'll have the opportunity to have this, knowledge and take advantage of it, because it is where the bread and butter is of any professional options trader is. It's really a lot of stuff in here is not what you're going to find in books or online. It is what the floor traders aspect of volatility is, and you're not going to get that anywhere else. I can guarantee you that. So another thing is, my guys are going to be calling you guys, and they'll be able to talk to you about the nuances of this course and answer any of your questions. And if they can't answer your questions, they're going to get you over to me. One other thing with this course is that you guys will have unlimited access to me. So, if a strategy is going against you, or you guys want to know more about what volatility is doing, or, if you want to know what delta you should be using on even something else, I'm going to be the one to reach out, or, reach back to you and say in a timely manner, hey, this is how I would approach this particular thing. So you get access to me directly, and I will be able to answer your questions. And if you take this course, you guys, volatility, and knowing that, it will pay for itself, especially at a 50% off price. You guys will be able to pay for that in a matter of a couple of trades. As a matter of fact, I think we were looking at Amazon, my Amazon earnings trade that took advantage of this volatility crush, and basically step by step went through, would have paid for this particular course. So it's super important, especially having access to me will really pay for itself in the long run, for sure. So this course is designed to make consistent winners and increase your probabilities of success, and it's a great technique. I really implore you guys to at least explore this and take advantage of it. Please explain how dividends hurt. Dividends can hurt you because the way that the pricing is. So if you're short calls, that are in the money, you know, you're expected to basically pay for those dividends. Same thing as if you're in the money puts, you know, you're expected to pay for those puts. And if somebody wants to assign you on that in order to put that stock to you to just take advantage of that dividend, you know, some people are very concerned about dividends, especially on higher dividend paying stocks. You know, if you're in the money puts, you're short in money puts, somebody's going to, you know, stick it to you basically. Does that make sense? All right, so keep that in mind, and please reach out to me, you know, with any of your questions, because I don't want to see anybody fail. You know, the more participation all of us have in there, you know, some people talk about, well, there's, you know, one winner, one loser. Well, with options, there's not one winner, one loser, because I might be buying a call and you're selling a call spread, you know, and all of our views are a little bit differently, but this will ultimately teach you how to trade like a professional trader. So, and this is stuff that even some of the hedge fund guys don't know. I've thrown out examples of what Goldman Sachs said about, you know, buying calls right before an earnings, 5 days before earnings, and then selling them the day after. And literally that is the worst technique ever for trading options. And that was somebody from Goldman saying that. It's just ridiculous. So that could have been one of the worst things I've ever heard said. And the only thing that I came from that was that guy's probably actually selling those calls going into earnings because he wants to see that volatility crush. And believe me, there's talking heads out there that used to talk the opposite of their position on TV, and I've seen it where I'm holding the guy's paper on the floor and he goes out and says something completely different on TV in order to facilitate his trade. So I've seen it happen before. So don't let yourself get talked into seeing what those talking heads are saying all the time. So this is that link that is in the chat box right up here for the volatility course, and really take advantage of it because it is well worth the money. And you also get the daily market commentaries that I talk about on this. All right, that's all I got for you guys today. I appreciate you guys sticking around a little bit longer than what the time was allotted for, and I hope you guys all have a great weekend. If you can't take that, take it easy. Oh, and somebody was asking about how I got the name Wolfman. That was from CNBC. I used to do stuff on CNBC with Rick Santilli, and Joe Kernan actually coined that. Could never remember my name, I guess, and just started calling me Wolfman because I had kind of shaggy hair and scruff, I guess, and it just kind of stuck. All right, guys, take care.